Everybody's looking that way, and that usually means the opportunities to look the other.
Hey guys, welcome back to Library of Wealth. Today we have the Real Vision CEO Raoul Pal giving us a market update and why he's so bullish in 2023. Raoul sees the potential effects of current economic and technological developments on various markets and believes 2023 will pave the way for the next two cycles. He maintains his bullish outlook on crypto for this year and is now expanding to many of the AI technologies that are capturing the world by storm. In the first quarter of the year, despite the negative sentiment among investors and the possibility of a mild recession or a soft landing, Raoul sees massive upside this year with the rapid advancement and adoption of technology, specifically AI, and its potential impact on the job market. Let's get right into the interview as Raoul Pal gives us a market update and where he sees the biggest opportunities this year. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I'm actually very bullish. Now, the recovery from a bear market either comes two ways. Either it comes up, corrects, and then eventually goes, or it comes sharper. It depends on central bank action, liquidity, that kind of stuff. But if I look forward, I'm very bullish because we've just gone through the rate cycle, so that's out of the way. So we've got the downside rate cycle. It might stick somewhere in the middle, which I don't think they will, but let's say the consensus is right. It's the rate of change that matters. The rate of change comes down first, then sticks. So that's good for risk assets. That ChatGPT went from 0 to 1 million users in 4 days. We've never seen anything like it. And it keeps crashing. There's so many users on it. So that's the technology, and we've got tons of these coming. You know, the energy situation that you've been following so closely, you know, the nightmare in Europe didn't pass in the end. It's, you know, we saw what was bad, but, you know, the Peter Zeihan's of the world and others were like, you know, the Europeans are going to be having to be chipping frozen corpses from the streets. That doesn't look like that's happened. Nobody's run out of energy. Yes, there's been some rationing and stuff like that, but it seems to be contained. So also investors were so negative that I've got charts going back to the 1970s, the AAII investor intelligence survey. It was the most negative since 1970 or something crazy. So usually when all of those things happen and we've got liquidity returning, market's pretty positive. So I love this series because I think everybody's looking that way, and that usually means the opportunities to look the other. But I'm hearing more of this kind of mild recession, soft landing calls from people. And I don't know really yet, I don't really see that. I see short and sharp, and we'll talk about that later in the second half, but I don't really see the mild element. Maybe it's to do with, you know, if we go back to 1980, the Volcker one, right? Everyone talks about that as like this terrifying recession. It was actually a really mild one. And the S&P went down 28%, and that was it. It was kind of over and done with. So maybe there's something to do with nominal versus real. That means that prices remain, you know, demand remains higher because of nominal. The inflation weight is less, and therefore the rate of change of interest rate increases. The Fed are making it pretty clear they're probably going to go to 25. So it's, as you know, in global macro, it's the rate of change that matters more than anything else, not the absolutes. So if the rate of change changes, all of these beach balls start popping out of the water that have been held down by the heavy weight of interest rate rises and that rate of change. That's all gone. So suddenly, you know, emerging markets go up, gold goes up, crypto goes up, equities go up. You know, that whole story. I don't know what the BOJ is doing. I've kind of lost track of them. I almost kind of, I know it's a bad thing to say, ignore it, because people over focus on Japan. And in the end, it's still pretty contained. It's not like they're going to let rates go to 2%. So, you know, and are they going to, I was having this conversation with Julian Brigden earlier on the Insider Talks, is are they going to let it all go and just give up yield curve control and walk away? I mean, no, they've just widened the band. Why would they suddenly decide, oh, you know what, we're just going to let interest rates run wild in Japan now and completely destroy everything? So, but interesting market overall. I mean, you know, it's been a very risk-on week, very risk-on.
What do you make of this price cut from Tesla? Is it something worth watching?
So Tesla doesn't have its own dealer network. So really, to manage inventory, they can't ram it into the dealers. So what the other car companies do is give them cheap loans and ram the inventory into the dealers and let them deal with it. So what's happening here is they have to deal with their inventory. So I think it's the right thing to do because, you know, the price of secondhand Teslas has been falling as all secondhand cars have. And so to stimulate demand, if they're able to do so directly, why not do it? You know, and maybe they gain market share from it. But it proves the point, and it's the point that even Elon Musk was making, is the inflation picture turned a while ago. I mean, I remember him in the summer saying, most of the basket of stuff we're buying is down 50% from the high. So I think what we're seeing from this is, you know, if you think of two businesses of Elon Musk, one is Twitter, one is Tesla. What has he done at Twitter? Laid off tons of staff. And what has he done at Tesla? Cut prices. That's a recession for you, right? That's exactly what recessions are all about. That's exactly what the Fed want to see. They want to see prices come lower. They want to see a rise in or a lowering in wage demand. So, you know, it's kind of exactly as the framework that you and I have been looking at for a while, which is, you know, recession is coming. And I've lost count of how many, particularly tech companies, have done this now. I mean, it's just endless. I mean, everybody's done at least 1 or 2 rounds or 3 rounds of cutting headcount costs. And prices generally, we've seen discounting. And remember, you know, I think even you and I talked about this, there was a massive rebuild in inventories. Excess inventories that were carried into the end of last year. And you kind of knew that after Christmas, anything they didn't sell was going to have to go out the door. And so I think we will see this everywhere, where we see some massive discounting to clear inventories. And again, classic part of a recession. Inventory liquidation is what recessions are all about. So, you know, I think we'll see a rapid inventory liquidation in the first quarter. I know some people absolutely hate Elon Musk. I just observed the whole thing, and a lot of people are like, he doesn't know what he's doing. I went onto a 2-hour Twitter Spaces of him with a bunch of engineers about the Twitter tech stack. I mean, the guy knows it inside out. His tweets are kind of like a snapshot of his monkey mind. Actually hear him talking. He talks in extraordinary detail about stuff that, you know, is beyond my understanding. And I then went through the rabbit hole of listening to long form Elon Musk interviews to say, okay, what is this man really about outside of the Twitter noise? And I came away, I was surprised. You know, when you hear him talking about artificial intelligence, self-driving cars, rocket engineering, you know, all these things. I mean, his knowledge is not superficial. Put it that way. I mean, extraordinary.
Throughout 2022, the big question as Americans continue to battle high prices was whether the Federal Reserve would push the economy into an economic downturn. To slow economic growth and bring inflation down, the Fed hiked interest rates 7 times during 2022, and its aggressive tactics had some economists and lawmakers concerned that the tightening could lead to job losses and an eventual recession. Now, with the surge in demand for AI platforms just in the last few months, many analysts now believe that we might reach 90% of online content generated by AI by 2025. Because this is exponential, many believe that the majority of digital content is going to start being produced by AI, which we've seen recently with ChatGPT and a whole plethora of other platforms and applications that are emerging. What do you think about Raoul Pal's view on the economic and technological developments happening in the market today? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.